Major funding for these programs is provided by grants from Capital One Bank and Perfect Building Maintenance, Murray Hill Properties, SJP Properties, Cushman & Wakefield, Greenberg Traurig, LLP, New York Community Bank, Bank of America, Kilroy Metal Products, New York's Window Company. Additional funding is provided by Akron Gold Brothers, LLC, Briarwood Organization, C.B. Richard Ellis, City Investment Fund, Essex Capital Partners, Excel Realty Advisors, First American Title Insurance Company of New York, FirstService Williams, Gemini Real Estate Advisors, Hal Fettner, Durst Fettner Residential, Helmsley Spear, James D. Kuhn Real Estate Institute at Syracuse University, James Orphanides, Massey Knackle Realty Services, Madison Realty Capital, M&T Bank, Meridian Capital Group, Newmark Knight Frank, Muss Development, PALIN Enterprises, Rosenthal & Rosenthal, Signature Bank, Sterling & Sterling, Stephen Napolitano, Stonehenge Partners, Studley, the Moinian Group.
Hello, my name is Michael Stoller. You know, in this crazy world that we live in, I don't have an apple to play with, but in this crazy world that we live in, there is a limited amount of money for real estate transactions. But there are people who are providing money. And today I have brought together 4 people who allegedly, and I must say allegedly, are still lending money for real estate. So my guests today include Gideon Gill, Managing Principal at Madison Realty Capital, Ira Bergstein, Principal at Palisades Financial, David Hayden, Managing Partner at W Financial, and last but not least, to round out, Greta Guggenheim, President at Ladder Capital Finance. So since you are the newest player in town, formerly a UBS banker, what do you see out there? What do you like lending on? Are you lending money?
Well, we very much want to lend money, and we're actively quoting transactions, but we're finding that borrowers feel they have time. They're getting time from their existing lenders, and they're not really excited about the rates that lenders want to lend at today.
Why? Don't you guys have been in business a long time? I mean, people are aware of what the rates are. I mean, we are not dealing with banks. You know, as someone said when we were in Chicago last week, Gideon, you and I, you know, a bank was over there. He said, "You're the unregulated people, and you're providing a bridge. So shouldn't we get paid for that bridge?"
We should, and we are quoting prices that folks seem to be interested in. It's more a question of their necessity at this point in time. You don't really see that sense of forced or panic yet. Even some counters where you almost feel the sense that they're trying to pressure you, like, oh, you're the bank, and that you might have more pressure, and that maybe there's a discount in order. So we don't see that capitulation yet in the marketplace, and it is coming down to proceeds and not as much about rate.
What are you seeing, Ira?
I'm seeing what I refer to as anticipatory lending, or looking at deals that are about to come.
Term.
You like that? Anticipatory deals where we're looking at projects where we think the lender's going to have a problem. The lender might not be around in a month. The lender might accept a discount off their loan. So we're analyzing the project, analyzing the sold units, the unsold units, the inventory, and the various levels of pricing, where we will be ready to take advantage of the situation when it comes.
So in a quiet way, it sounds like you and Greta are looking at deals, but you're not putting out any money. So you're like Bank of America and Chase.
We're trying.
And you, David?
We're closing deals. We closed a deal last month, and we're closing something this month. And we were very active in December, but we're trying to pick and choose our battles very carefully. And it's not quite there yet. There's a disconnect, and there's going to be a wave of people buying their debt back at a discount, and that hasn't really hit yet.
So let's look at it this way. You know, I have people who watch my show in New York City, East Hampton, Montauk, around the country, around the world, on the internet. What type of deals do you like lending, and you know, what are you really charging? You know, as opposed to being evasive, Greta.
Well, we have. I think what lenders can charge is somewhat it's dictated by the market, and in some ways it's dictated by their own financing costs. If we can finance our origination, our new loan, under our existing line of credit, we can go as low as 8%. If it doesn't qualify for that, either because the borrower needs a longer term than 2 years, then we're going to hold it unlevered, and our cost of funds is going to be, our minimum cost of funds is 13%. So we would want the loan to yield 13% at a minimum.
And you, David?
We're typically at 12% and 2 points, but for the right deal, we'll drop down to 10 or 11. We're focused on quality, not on yield right now.
Ira?
2 and 12 is the floor.
That's the floor.
That's the
and
floor.
what's the ceiling? But the sky's the
Sky's
limit.
the limit.
Ira, let's remember, if you can get a pricing that's too high, then you know it's a bad deal.
Right, absolutely.
Right?
Right. If you can't pay too much money to give money away, and if somebody's willing to give us too much money, we know there's a problem going in, and what you call one of those first payment defaults, and they're going to rip up the book going out the door, and you're going to have a problem the next day.
You know,
we don't need
the
that.
day after you close it.
We don't need that.
And Gideon?
We're similarly in the 12 to 13% range, a couple points, but we have the ability to go less than that as well if we can find similar type leverage, but we do it more with the local savings banks.
But what kind of real estate do you like? I mean, if somebody came to you with to develop, I mean, I wrote an article today, and I got 5 emails. You know, do you know people at these different institutions? I was about to say, "What do you want me to open up my Rolodex to you?" I mean, but what kind of transactions do you like? You've said last week when we were in Chicago, you recently, or you maybe be bidding on a hotel. An office building in Lower Manhattan. What else have you been seeing?
We're seeing condo inventory loans, really seeing all property types all over the country. And what is key, what attracts our attention is that the dollars per foot or dollars per hotel room are reasonable, you know, really going back to values of, you know, 5 to 10 years ago in many cases. And we like income. We also like borrowers that we know have treated their lenders well in the past.
And you?
We're focused on 2 things. We're focused on properties that either have cash flow or can have cash flow without too much heavy lifting. And we're very focused on the exit strategy. If people stay with us for 18 months or 2 years, they're going to go into default. So there's got to be a clear...
So you're saying you really like to get paid out in 12 months?
We're in and out, yeah. 6 to 18 months is pretty much a typical time frame for us. So we need to make sure that people can take us out in a reasonable period of time.
Ira?
We like the condo loans, and we're not afraid of the almost completed or even the substantial amount of work to complete. We are comfortable in the construction world, so we've got to get people in there to finish a job. We're happy to do that. So if there's lower pricing to be had to get the job finished, that's something we'll look at.
So you're going to get your toolkit, and you're going to...
My work boots are
You
ready
got
to
your
go.
work boots, and
They're
you're going to
ready to
go
go.
out there and work on that?
In my trunk, always.
Always in the trunk.
Always in the
Okay.
trunk. Remember, I was in
really?
the plumbing business for 10 years.
Excuse me?
I was in the plumbing business for 10 years.
So this is a very appropriate.
Very
Plumbing
easy.
money.
Yeah,
Okay.
it's very easy.
Right, so it hasn't changed.
Right.
And Gideon?
Similar. I mean, the big thing, income. We want current income. We want to focus on property types that are really under the category of necessities and lower volatility. And like I'm sure most of my fellow panelists would say, it's, you know, multifamily first, and then maybe you go into student housing, medical office, other properties that people really just have to
So
attempt.
I have a really good question. What items would you not lend on? I mean, you know, people are going to watch the show. They're going to catch it on the internet. What is a no-no? What's something that under no circumstances would you lend on?
We really don't want to do construction loans in this market. We feel that, you know, occupancies are falling in almost all property types right now, and just don't want to be holding a product that is completely empty.
But would you take
finished.
something like what Ira was saying? Would you take a property that's near completion?
Near completion, but that means it's 90% through. We don't want to have to worry about completion guarantees. and ending up with a half-finished project with budget overruns.
So construction is a no-no. And you?
We shy away from land these days. We also try and stay away from a business that's wrapped in a piece of real estate like nursing homes. We're very negative on the hotel and motel industry right now.
What about restaurants?
We're negative on a single-tenant restaurant. We're multifamily, unsold condos.
But you know, when we bring up single tenants, what's your position on a single-tenant owner-user type of property?
If it's owner-occupied, we're out right now. We think it's the wrong time of the cycle to be chasing that. So we're looking for diversified properties, some office, some retail, some mixed-use, some multifamily, some unsold condos. You know, things that can really get us out in a reasonable period of time without too much heavy lifting.
And you, Mr. Plummer?
Specialties, probably no more mountains. We've had enough of the ski resorts. Successful exits, so we're good there. I think retail is, as I were talking earlier, still a falling knife, and co-tenancy clauses need to be looked at, which haven't been looked at in 10 years.
So you don't like retail?
I think retail is very dangerous right now.
Why?
Because
don't people need, you know, your office is in New Jersey. There's an article that I'm writing that this month at the Bergentown Mall, they're having 600,000 square feet of new tenants, 181,000 square foot Target, Whole Foods, and then
Nike store open with 300 people out the door Saturday.
Nike store open Saturday, same day as Target, and now they're opening up an 80,000 square foot Whole Foods. And then 5 days after that, at the Paramus Fashion Center, they're opening up a 50,000 square foot Fairway Market. So I think depending on what the retail might be is really the question.
And where as well. I mean, Bergen County is probably going to be somewhat more resilient than other markets. Bergen County still has a reasonable amount of wealth in there. So.
Yeah, I would say, you know, you have to follow people. I mean, getting back to your question about where we want to lend, we basically want to lend where the banks want to lend because we want to ultimately be taken out by some secure, more permanent type financing. So, you know, to echo some of the points.
So you don't think Phoenix is a market?
We probably would not be doing deals in Phoenix, but
Las Vegas?
Probably not doing deals in Las Vegas either. But you know, there are opportunities, and you know, a lot of what we all do, there's a story, and it's sort of how compelling the story is. And in a lot of cases, even today, you can believe in some value creation. I don't think any of us are going to pencil growth.
But you know, you talk well on the story. The story is an interesting thing. Everybody had the story about Williamsburg. You know, that was the up-and-coming thing. You know, if you were Echo Boomers was an interesting thing. The new generation was the third. I mean, Williamsburg, you know, you're not allowed. You're too old over there. I mean, you know, you really had to be this. And they built all these new condos and everything else. I mean, what's your thought? I mean, have you ever looked at a deal in Williamsburg?
Well, when we were at UBS, we financed someone who was on your show quite recently on a very large project.
Yes, yes. Yes, Mr. Positive, yes.
And fortunately, a very, at one time, solid financial institution took us out of that. But you know, I think we would stick in the core markets. I mean, we will look outside outside of the main metropolitan area and look in fringe markets if the core market is strong. But we have such weakening here in Manhattan. I don't really.
But you know, I think this is interesting, especially for my viewers and for the perspective over here. You know, Williamsburg was a hot neighborhood, and it's still there. I mean, people were saying Long Island City, the next panacea. And my joke, and I like Long Island City, but if if you're right near the subway, you also have the bus that takes you to Rikers Island. And you know, Long Island City, you know, everything. You know, I came in when we came back from Chicago last week. You know, there's a building at the entrance of the tunnel. I mean, you know, you can have good smog, you know, good controls. I mean, are you scared of places like Long Island City, Williamsburg, Brooklyn?
I don't think we'd be too active in Long Island City now, but we closed a loan in Williamsburg in October, and we would still close one there again. But you know, it was an unsold condo, and we didn't value it as condos. We valued it as a rental job. So, and the key to that is, can a bank take us out? And are there banks lending on broken condos that are leased up as a rental job?
And what about the Bronx? You know, and Harlem? I mean, Harlem was growing. I mean, everything was moving over there. You know, and today there's a lot of unsold units in Harlem.
All those stories. Williamsburg, Long Island City, Harlem, they all were very compelling stories as long as New York City proper, Manhattan, was a thriving, strong marketplace. And a lot of them were alternatives, you know, a lower cost alternative. And as we all have seen, Manhattan is now becoming itself a lower cost alternative to what it was. So it's putting a lot of stress on these burgeoning neighborhoods over there. And there's still pockets of goodness in those areas, but you have to be really selective. The one thing that we have seen and sort of learned is that a lot of it relates to who your sponsor is. And it's not just pick a location, any location works. It really is who your sponsor is and who you're going to bet on in order to get you to the finish line.
The outlying areas, the last to rise are usually the first to fall. And you come down and to Riverdale, you get a lot of shells of buildings today, which you're not seeing.
No, I think Riverdale is a good example. I mean, Riverdale, people don't realize that Riverdale is the Bronx. It's a very nice section of the Bronx. It's a good location, but there are a lot of shells over there. And my good friend Tom Lydon, the City Investment, they had a good property. They couldn't sell it. Fortunately, they had Columbia University buy the units. But there are other deals in over there that aren't selling at all. I mean, you live up in Westchester. What's happening in the Westchester market? What do you see?
Very quiet. Everything obviously that was on the plans got scrapped. The housing market between $1 million and $2 million is dead. You've still got under $1 million. The brokers are saying there are people looking, but I think the numbers were 200 in the first 2 months, 250 sales down to 120, so 53% off. So you're seeing.
But especially we're talking about Westchester County. There's a lot of planned development in New Rochelle and Yonkers. Would you or anyone sitting here be interested in a transaction today in New Rochelle or Yonkers or Westchester? Because like Capelli's deal in White Plains, I heard stopped doing any business.
That. Sold the first building, and I understand the second building they're having some issues with.
What about?
But I was going to say I don't think any of us, if I would say so, I don't think any of us are betting on future growth or development. I don't think that's the play right now because there's so much both to absorb as well as to really get through. Everyone is being more cautious both on the consumer side as well as on the lending side, and you just see this continued massive pullback. So to really go after development, I guess maybe it would make sense in some of the retail cases that you were mentioning just because it's incredible infill locations, but otherwise it's really hard to make a case for.
I mean, as you say, Bergen County is an interesting market. It's an affluent market, and I wrote in my article that people will go to Bergen County or New Jersey to shop because there's no sales tax on clothing. And that's one of the few advantages of going over the state line over there, because you're paying for the tunnel and you're paying this. But if you're going to be shopping and you're going to spend money, you're going to get it back on the sales tax.
And gas is 50 cents less, too.
Gas is 50 cents. But that also relates, that some Tanger Outlet Mall in Riverhead, which has been always a successful mall, volume is down at least 20 to 30% because it's a 55-mile or 70-mile ride from the city, and the sales tax is 8 3/4%. So you look at the situation right now. The city sales tax for clothing under $100, there is no sales tax, but over $100. But what's happening with the economy and everything, it's going to change. Now, you brought up the subject, and I'm in firm agreement with you on the hotel business, that you don't like the hospitality business because it's a little tough. Why do you, what's your feeling on that?
Well, it did very well the past few years with the weak dollar, but now with less tourism, 80% of the tourism in New York is from domestic travel. We're in the middle of a recession. It's pulling back quite a bit, and with the issue with the dollar is also pulling back. So we think the hotel industry is going to be in for a rough time this next 12 months.
Ira?
I think the higher end hotels may have some difficulty because they really can't cut service. Where if you've got occupancy at a 50% level, you really can't cut staffing because you've got to maintain your Michelin ratings at 5-star. When that customer comes who's been a regular customer, they want to know that they're going to get their service and they're going to get it quickly. Whereas a 3-star hotel maybe can cut service a little bit. If you have to wait 10 more minutes for food, it's okay and it's not going to ruin your rating. But I think the higher end hotels may have some issues if this lasts a long time.
So I have a question. People say, how do a two-pronged question? Banks are banks, and people can look at a directory and there's a bank. How do people find you? How do they find a ladder capital? How do they find a W Financial, a Madison Realty Capital, a Palisades? I mean, is it 1-800-SHYLOCK, or you know?
It's 1-800-RELIABLE CLOSE.
Reliable close. That's a good one. I like that. But all joking aside, how do people know about ladder capital? I mean, you're only around for a couple of months. I mean,
Right.
W's been around, Madison's been around for 5 or 6 years. Palisades has been around. So, but how do you build customer base?
Well, I think that when you close a deal and you advertise that you have money, they find you in this market. I mean, we made a conscious decision not to spend too much money on marketing this year because there's so little liquidity that those who need money will find those who have it. And that's been the case so far.
David?
That's the key. You're as good as the last deal that you closed, and if you do it reliably and you tell them you're going to close on Tuesday and you close on Tuesday at the pricing that you quoted, word of mouth will do the rest.
Our best source of business has always been the professionals, the accountants, the lawyers, those who have clients that have an issue, need to get a quick close. They'll call us, tell us the situation. We sound interested, their clients the next call.
Gideon?
I would say we also have some deep relationships within the real estate community on the broker side, on the bank side, a lot of referrals, execution, and we like to think user friendliness is actually one of the biggest attributes in our space.
The week before I did a show and I had 5 bankers. One was from Chicago, the rest of them were regional, and there was this terminology on guarantees. That was a word. It's like the dinosaur was extinct, and then the guarantee was taken out of the picture. In today's situation, are you looking for a personal guarantee from your borrower? Or do you say the guarantee's not worth anything? What do you say?
Well, we're asking for it, mainly because I think everyone else is asking for it. But
I mean, you never asked for it when you were at UBS.
Never asked for it. That was, they'd walk out of your office. But we look at the property first. It has to stand on its own. And if we're kind of on the fence, we think there might be a dip in cash flow, or there's tenant roll that you need TI and leasing commissions for, and we're just not sure we'll build up enough cash for it, yes, we'll ask for it. But generally today, we're asking for it in all cases because we believe most other lenders are, and we can get it.
We're a full recourse lender. We always get a guarantee, and we find that it helps keep the principal focused on the transaction.
Exactly. We like when our borrower wakes up in the morning, we're the first thing that they think about.
I would agree. Full recourse.
Now, that's an interesting thing. You and I spoke a couple of weeks ago about a borrower of yours with an interesting situation. How do you sometimes collateralize a loan? I mean, sometimes the loan, the one asset that you may have, the building may not have enough cash flow or other things, and we spoke on my panels and other things. I had my friend from Progressive Credit Union who lends on taxis and other things. He'll take the firstborn if he could. I mean, what other collateral do you ask for? Other collateral?
Sure. The first question you ask is, what else do you have? But generally we're a first mortgage lender in this environment. And the rule of thumb is take as much as you can get your hands on.
We found that the property that we're lending against isn't always the property that pays us back. And that another piece of collateral that somebody has, an apartment building, maybe something that they'd get money out of, and the business plan didn't execute as fast on the primary collateral, so we'll get repaid partially from the secondary piece, and the primary is after.
Yeah, I would say, like, in this market, with capital being so scarce, especially our collective capital here, it's all our balance sheet money, there's no margin for error. So any way that you can better a deal with additional collateral or some sort of assurances, pay downs, anything which you can get comfortable with only betters the case, because you do not want to be in situations where you left something on the table in this type of declining market.
Do you like to meet your borrowers?
Always.
Always, you have to meet them. When it comes down to it, the deal is very important, but the borrower is even more important.
So basically, I may be a little older. I mean, when I started out in banking, there was the 3 or 5 C's of credit. Character was an important situation. I mean, today you have to really see, you want to meet the individual, you want to know the character of the individual, the capacity of the individual, the capacity of the property to pay. It's a different world. I mean, unfortunately, I don't want to say this, but when the world that you came from created a lot of this havoc that came out of this because of the collateralized mortgage and the inordinate amount of money that was available at that time. So that changed, and now we're looking at the difficulties. You know, we were talking prior to the show with regard to the question of values. What have values dropped? What do you really feel that values in the metro area, I don't want to talk on a national area, what do you think values have really dropped from their high? Because what happened is we were discussing with a condo, you know, the condo may have been priced at $800, then they priced it to $1,200. From their high, what do you think values are down with regard to lots of different assets?
Yeah, we'd have to start, if you want to talk about office, and you can break that down into several categories, it could be as much as, I think, 40 to 50% on the very high end. In your class, call it B plus and down, it's probably less. And that's also a function of rents, which we all know is a very difficult metric right now to get our hands on. Condos have declined, although, again, similarly, we don't know exactly by how much. The interesting about rental apartments, which is the one product type that we thought was going to be the most insular, is probably, you know, at least we're hearing, you know, down at least 10% and a month free. So you can say that's about 15, 20%.
What about you, Ira?
I mean, I think we all agree that cap rates on office are probably no longer going to be at 5% for quite a while. Just on a cap rate change from a 5 to an 8, you'll see a 40% drop, and that's if NOI holds. And
yeah, that's on office. But what about, you know, we were talking, Gideon and I, earlier today on land. I mean, land in New York City had gone up to the price, to the inordinate amount of $500 a foot. You know, and that was for land that didn't even qualify where you could build residential. What do you think land is down today?
I'm seeing land for between $2 and $250 a square foot right now.
You still seeing it at that number?
No, I'm seeing lenders, borrowers that are in for that basis that would gladly give the keys back and walk away.
So you're saying, right, at $250.
Yeah.
So if you're saying a borrower will give you the keys back for $2 to $250, so the land is probably down to as low as $100, between $75 to $100.
I don't think in Manhattan it's at 100 yet, but I would probably say 175 to 200.
Okay, and in the boroughs, it's probably $50 to $75.
You'd probably say 75.
What about you in New Jersey? What do you see in Jersey?
$50.
$50.
$50.
From what the high was, what, 200?
I don't think we sold 200. I think your top is 100.
Really?
Yeah.
That's it. So, you know, I think what we've been able to do today is really give my audience a fact that the 4 individuals sitting here continue to be in the market for financing. If the deal makes sense, if the borrower has the capacity, the credit, and, you know, you'll be there, okay? You may not be the lowest cost, but you're a cost that you will close on a transaction. I'd like to thank Gideon Gill, Ira Bergstein, David Hayden, and Greta Guggenheim. See you next week.
Major funding for these programs is provided by grants from Capital One Bank and Perfect Building Maintenance, Murray Hill Properties, SJP Properties, Cushman & Wakefield, Greenberg Traurig, LLP, New York Community Bank, Bank of America, Kilroy Metal Products, New York's Window Company. Additional funding is provided by Akron Gold Brothers, LLC, BRIARWOOD Organization, C.B. Richard Ellis, City Investment Fund, Essex Capital Partners, Excel Realty Advisors, First American Title Insurance Company of New York, FirstService Williams, Gemini Real Estate Advisors, Hal Fettner, Durst Fettner Residential, Helmsley Spear, James D. Kuhn Real Estate Institute at Syracuse University, James Orphanides, Massey Knackle Realty Services, Madison Realty Capital, M&T Bank, Meridian Capital Group, Newmark Knight Frank, Muss Development, PALIN Enterprises, Rosenthal & Rosenthal, Signature Bank, Sterling & Sterling, Stephen Napolitano, Stonehenge Partners, Studley, the MOINIAN Group.